Hey traders, and welcome back to another episode of Trade Empire. This video is going to be an advanced tutorial about the concepts of market structure in smart money trading. In this episode, we will dive deeper into identifying the trends, pullbacks, impulsive and corrective moves, break of structures, change of characters, and we will do multi-time frame analysis like a professional smart money trader. So let's start our video after a short intro and disclaimer. The first step in analyzing the market structure is to find a valid pullback, as pullbacks are considered a temporary pause before price resumes its general direction, and they are used to identify the basic price movements, trends, valid breaks, and valid reversals. So, how do we identify a valid pullback? The pullback is a candlestick-based concept. The candlestick-based uptrend refers to a pattern where market forms a series of bullish candlesticks that exceeds the highest price reached by the previous one, indicating a continuous upward momentum, and the low point of each candle remain above or equal to the low of previous candlestick, signify that the market downward pressure is limited, and the overall market trend is bullish. The downtrend refers to a pattern where the market makes a series of bearish candlesticks that exceeds the lowest price reached by the previous one, indicating a continuous downward momentum. Also, the high point of each candle remains above or equal to the high of the previous candlestick, indicating that the market upward pressure is limited and the overall market trend is bearish. In addition to analyze the market trend, it is essential to consider the candlestick-based trend as well. How to identify a valid pullback? In a bullish scenario, when a candle breaks below the lowest point of the last bullish candle and sweeps the liquidity below it, we consider it as a valid pullback. As here you can see that the fourth red candle has broken below the lowest point of the third candle. So, we have a valid pullback here. But if price could not break it to the downside, that pullback will not be considered as valid. Remember one thing, the candle color does not matter while identifying pullbacks. Same for the bearish scenario. A valid pullback is identified when a candle breaks above the highest point of the last bearish candle and sweeps the liquidity below it. Now let's see some other examples to understand more clearly. In this example, we have a bullish candlestick sequence, followed by 3 bearish candles, and this is our latest high that created the latest low. But we will not consider this as a valid pullback, because none of the candle breaks below the low, and this is a move inside the previous candle, as we have no liquidity sweep. And that's why we will consider this as a single bullish move. But in the next example, we can see that the bearish and bullish candles have equal highs. So breaking the low of the bearish candle will make a valid pullback. Same concept applies to the bearish scenario, and you can apply this in any market and any time frame. Now let's see some real chart examples to learn practically. Here on the goal for our chart, let's identify the valid and invalid pullbacks. Starting from left, this is our latest high and low point. And none of these candles broken below the low, so this is not a valid pullback. And we will consider it as a single bullish movement. To confirm a valid pullback, price must break below the candle that created the latest high. Following, we have a clear valid pullback, because the low of this inverted hammer candle has been swiped by these bearish candles. And once again we have this valid pullback that broke below the candle that created the latest higher high. In a downtrend, the price must take out the high of the previous candle that created the most recent low to confirm the pullback. Now that we have discussed the pullbacks in terms of candlestick form, let me show you the impulsive and corrective moves in terms of market structure. When market is in an uptrend, an impulsive move refers to a strong bullish movement, indicating a heavy bullish momentum in the market. And then a correction refers to a temporary market retracement or reversal that takes out a pullback. And a break of structure forms when price breaks above a structure level after a corrective move. It indicates that the market tends to continue in the same bullish direction. And a change of character occurs when price breaks below the low of the corrective move. It shows a loss in momentum, and it is a signal that we are no longer in an uptrend and might witness a reversal in trend. Now let's learn all these things on real charts. Here on the gold 5 minutes chart, we can clearly see that market momentum is bullish, as it made a pullback and then push higher. And the following move is identified as a corrective move, since it has taken out the liquidity below this pullback. And when price breaks this higher high to the upside, it becomes our valid break of structure, which confirms this level as a valid higher low. Next, we have to identify that where is our most recent liquidity and pullback. Our most recent pullback is here, and the liquidity lies beneath it. And if the price makes a deep retracement and takes out the liquidity below this pullback, and then starts moving upward, then we will have another valid break of structure. Now let's see what happens. We can clearly see that price broke this level to the upside, but it did not take out the liquidity below this pullback. So, we will not consider it as a valid break of structure. According to our rules, price must take out the liquidity below the pullback to confirm a valid break of structure. So now, this is our most recent pullback and it remains unmitigated. And the liquidity lies below this pullback. And if price makes a deep retracement and take out the liquidity, it will be identified as a corrective move. And we will have a valid break of structure if the price continues pushing higher. And now this is our most recent higher low. And what if price breaks below this point? If price break below this higher low, then we will have a valid change of character. And after this case occurs on the chart, the market overall trend will change into bearish. Now, we will consider the movement that created change of character as our new impulsive move to the downside. So once again we will apply our market structure rules. First, we will identify the pullback and liquidity takeout to confirm our corrective move. This is our most recent pullback in terms of candlestick formation. And we can see that price take out the liquidity above this pullback and continue pushing downward. So, we will mark this point as our new market structure. And we also have a break of structure to the downside, confirming this level as a valid lower high. Remember, this market structure concept is not limited to any time frame, or any pair or any market, but it will take time you to master it. So keep practicing it on different pairs in various time frames. Now let's move to our next topic, analyzing the market structure in multiple time frames. By analyzing the structure, we gain a comprehensive view of the market conditions, allowing us to spot the key levels, trends and patterns that may not be apparent in a single time frame alone. This multi-time frame analysis allows us to make better trading judgment. So, how exactly we analyze market structure in multiple time frames? Here are a few tips to get you started. We use two types of time frames. First, a higher time frame, in which we analyze the overall market direction, higher time frame key levels, and mostly the bigger picture. And next we have the lower time frame, in which we do most of our analysis, including market direction, supply and demand areas, liquidity zones, chart patterns, trading opportunities, and more. And after applying market structure concepts, pay close attention to the alignment of structure across multiple time frames. Look for confluence and agreement between two charts. And when structure aligns, it enhances the validity of your analysis and increases the chances of a successful trade. Now let's see some real chart examples to learn practically. Here on the euro-dollar for our chart. This is our higher time frame chart, and we have a clear downtrend here. So let's identify the most recent impulsive and corrective move and pullback. This is our recent pullback, as it take out the liquidity above the previous candle that created the recent low. And this move is our latest corrective move, as it take out the liquidity above this pullback. So as long as price stay below this point, we are in a downtrend. Let's see what price do next. As we can see that price break through the recent lower high and makes a change of character, so now market sentiment is shifted to bullish. And now our higher time frame is indicating that the downtrend is over and a possible trend reversal is coming. Now, we will zoom into the 15 minutes time frame to discover more details. Here on the 15 minutes chart, we can see here that price failed to create a new lower low. And finally it led to a change of character, so now, both for our end 15 minutes time frame chart showing a possible reversal, and we can now look for long opportunities. Remember, if you combine multiple time frames, it can provide you many benefits, including gaining a broader perspective, confirming trends, identifying entry and exit points, and increasing risk management. And by considering different time frames, you can make more informed and strategic trade decisions. So guys, that's all for today. And if this video has provided you some knowledge, please give us a like and subscribe the channel for more trading videos. Wish you good luck for your trading journey.